Good morning, ladies and gentlemen, and welcome to the second webinar for 2021 from Primewest. My name is John Bond and I'm the Executive Chairman of Primewest.
And I'm David Schwartz and I'm the Managing Director.
So this morning we wanted to cover two areas. First of all, the merger which was announced yesterday with Centuria. We'd like to give you some background on the rationale behind that and why we think it's a good thing for our investors. And then secondly, we'll give you an update on where we see the property markets around Australia in the various sectors and the areas that we think are going to be good investing going forward. So I'll start off by giving you a very brief background to Centuria. It's a company not dissimilar to us. They do similar types of investing to us, except they're bigger. So they have $10 billion of assets under management, and they focus largely in office and industrial space. So they have two listed trusts, an office trust, which is worth about $2 billion, and an industrial trust of about the same value. But interestingly, they also do private syndicates, very much the same as we do. And their assets are spread across those classes. And also, interestingly, in healthcare, which is an area we're not currently in. And I'll pass over to David just to give you some of the rationale for why we think this is a good idea for our investors.
So one of the things that we looked at when we looked at the possibility of putting the two businesses together, and the first thing we looked at was the culture. The question we asked ourselves, is the culture the same? And one thing that we've always done, we've always had the philosophy of putting investors first. And Centuria most certainly have done this in the past. Their philosophy is very much the same as ours. They're entrepreneurial. They always look for good deals for their investors. And like I said, they put investors first. So the beauty going forward is that we're going to be able to offer our investors, like John said, the opportunity to invest in healthcare. What we bring to them is we bring the retail experience, the large format experience, and now with our new push and drive into agriculture, we're going to be able to bring that to their investors. But with the size and scale of this business, we'll now be a total of $15.5 billion of funds under management, and that brings with it the opportunity to, again, look at things like the insurance costs, the costs of banking, and provide these benefits to our underlying tenants, which of course then means a benefit to our investors in the underlying, in the trusts that they're invested in. From the Primewest point of view, our team is going to be exactly the same. Nothing changes from your investment point of view. Nothing changes from the management point of view. John, Jim and I will remain on with the business. We'll remain on and as the trustees in the business. But the beauty of the size and scale is that we'll be able to present new opportunities. There's also things and benefits that they have where they have what is known as the Quantum Club, where we'll be able to invite our investors to enjoy the many benefits that are offered to the membership relating to the Quantum Club. John, I don't know if you want to give them a bit of background as to what's going to now happen with the bid process.
Yes, absolutely. So the bid was announced yesterday, and essentially it comprises $1.51 per Primewest share. And that's made up of 20 cents, which will be received in cash, and the balance of $1.31 will be received in Centuria shares. And so from here, there's a period of 2 or 3 weeks where takeover documents have to be prepared. There'll also be an independent experts report prepared by Deloitte to establish that this is in the best interests of Primewest shareholders. And when those documents are completed, they'll be put together in a package and sent to all shareholders. You'll then have a period of time to consider the offer and make your decision. And I must say that we had a lot of investor briefings yesterday with institutional investors. Many of them happen to be in both Centuria and Primewest because we're in a similar asset class as property fund managers. And I have to say that was well received, and the large institutional investors seem to see the merits of the merger. So there'll be plenty of time to consider the transaction, and David and I are certainly available to talk to anyone individually who has any questions about that. But so it'll be a process. It'll run probably until about the end of June. We'd hope it'll be wrapped up around about that time. And so one of the great things about the merger is the scale of it means that the combined entity should enter the ASX 200. That means it's one of the largest 200 companies in Australia. And with that comes the need for large institutional investors to buy shares. And what we've traditionally seen when that happens to other companies is the share price rises as those large institutions has to buy shares. So not only do we think their underlying business is good as ours, but we think that a drive for institutions to acquire shares will see really good share appreciation in the combined entity over the forthcoming period. And certainly we're all very happy to have our shares locked up, and we have no intention of selling them. So the other thing just to mention is the tax. Once we get to 80% takeover, the shares that you receive in Centuria won't carry any tax burden. So you will only pay tax on the 20 cents that you receive in cash, and you will get what's called rollover relief. So your Primewest shares will be converted into Centuria shares, and there'll be no tax payable on that transaction. So it's quite tax effective in that sense. So that's all we'll say for the moment on that transaction, and perhaps I might hand over to David to just give you a general overview on the various sectors of the property market that we're interested in today.
Thanks, John. I think the investors are probably more interested in this part of it. Well, while we're still very bullish on most of the property sectors, and we'll go through all of them individually, but just our general view of where interest rates are, while we're still in a very low interest rate environment, interest rates are starting to trend up a little bit. It was only in December that we looked at the portfolio, we looked at all our debts, and we've taken out swaps for about 50% of our total debt, which is about 930 million that we've covered forward for 5 years. That means that what we've done for our investors, we've locked in a portion of the debt in all the underlying investments, where we've locked it in for 5 years, and we're only paying 0.4% plus, of course, the bank margin. But that means we're locked in, and even if interest rates start rising, we're pretty much protected for the majority of the debt. We do see interest rates starting to pick up over the next 5 years, albeit not dramatically. It'll be small increases, but the turning point, I think, was probably December, where we decided to do those swaps, where we think that interest rates are going to start moving, albeit very, very slowly.
And fortuitously, David, we managed to lock those in at about 0.4 of a margin. That margin is now closer to 1%. So there's a very significant saving already achieved for investors in that move.
Correct, but we do also see, the inflation is going to pick up, and when inflation tends to go up, interest rates go up. So that was one of the motivating things for us to lock it in. And also what we're starting to do now is all new leases, we're making sure that our investors are going to be protected and make sure that whilst we do have this inflation increase coming through, that our rentals then pick up at more or less the same pace. Yeah. And in that way, we do give the investors the protection in case there is any sort of increase in interest rates. Yeah. And it's with that, what we'll do now is just talk about each sector. Maybe, John, you want to talk about neighbourhood centres and so on?
Sure. So we call these daily needs centres, convenience centres. And as many of you will know, we've been in this sector for a very long time. In fact, the first asset we ever acquired was the Gwella Shopping Centre. And the model is really very simple. we want it to be anchored by a Coles or a Woolworths, and often these days it also has an Aldi. And the reason we like that clearly is because they're very, very substantial covenants who can always pay the rent. And we've sought to limit the number of specialty shops that goes with them to sort of 8 to 12 shops and in the service area. So we've avoided fashion. And I think that's been proven to be the right strategy through COVID. The majors, Coles and Woolworths, have performed extremely well, and we're achieving turnover rent from them. And that's helped to support the smaller mum and dad operators who are often associated with those assets.
So but John, also, when you do get that turnover profit from Coles and Woolworths, the beauty with that is that also gives you a bit of a hedge with inflation. Yeah. So as inflation ticks up, their turnover ticks up, and we get that natural protection for our investors.
Yeah. And so, look, we really like that asset class. We always have, and we still do, and we're still interested in acquiring further assets in that space. It's important that we do our research, so we always use demographers when we're looking at a new asset to see what the population will be to support it, particularly going forward. So there's a lot of fundamental research that goes into acquiring these assets. And we're excited about the opportunity to buy more of them as they're available.
What we've also done is on the large format.
Yep.
You would have seen there would have been this last article for Rabina, which has just come through. The large format sector we think is going to still perform particularly well. You know, with all the stimulus that the government have put out into new housing and for the first home buyers, that takes a bit of time. And as the housing starts building up, we'll find that the spending for all the new appliances will start happening. It benefits all the large format centres, and it's an area that we think that is also still a bit of growth still to come. Yeah. And they've performed particularly well over the last couple of years and over COVID. We look at those that you've got a large piece of land, main, and worst case.
The covenants in those centres are very good. There's only 30 or 40 national retailers.
Yeah.
They're all well known to us through our 25-year history, and they're substantial entities. So you're not at the risk of having insecure tenants. And so they know their business well. And we really like that sector. We might just...
look, the office market is the one that's really... the one that's topical and tricky, because you know you've got this work from home, and you know you get different opinions. We think that it's going to be short-lived, but John.
Look, David and I have spoken a fair bit about this because it's a subject that comes up a lot with our investors. What's the future for offices? Well, we think the future for offices is still strong. Clearly, there's going to be more capacity within employers for their staff to work from home, but not full-time. We think staff want to be in the office, and we think employers want them to be in the office. And I think our office is a perfect example. We came back very early from COVID, and we know that our business runs much, much better when we're interactive, everyone's sharing ideas, everyone knows what's going on.
But also it's building a culture.
It is.
If you want to build a culture, you're going to do it when people are around you. And I think what is going to happen, yes, some people do like to work from home, but what you'll find is that when somebody wants to get a promotion, if you're not seen, you ain't going to get it.
Yeah.
And what people will find the minute there's a bit of a downturn, the first person to be laid off is the guy that they don't see every day.
Mm.
So we think that that's going to be short-lived. There is going to, people will go back to the office. It's not going to be 100% like it was before.
Yep.
But I don't think it's as bad as what some people are predicting, but there's still going to be opportunities.
And so the large majority of our assets, office assets, are actually in Perth. And I think we're fortunate in that regard, because Sydney and Melbourne, there's some difficulty in the office space. There was a lot of building done in those areas, and rents got quite high. In WA, as most of you would know, the economy is in good shape. There's a lot of growth going on with mining companies in particular, and all the service companies that support those mining companies are now starting to look to take more space. So particularly in Perth, we're quietly confident that our office assets will continue to perform and do better probably than assets in Sydney and Melbourne. So we're fortunate to have those assets located here at the time. We might just then move on to industrial.
Well, industrial's been pretty strong. Trouble is being able to buy. Our sweet spot really in the industrial market and what we've done over the past is really played in that $10 to $30 million range. Anything above that, the institutions tend to be bidding these things down to like 3 or 4%, and none of our investors are happy with 3 or 4%. So we've ignored the bigger ones and some of the smaller ones. That's our sweet spot. That's where we can get good returns and have been putting them into trust. So you're not solely reliant on the one tenant, which is often the case in these industrial properties. But as there's been this shift to more online shopping, that industrial space is getting used more and more. Little shops setting up, little guys, wanting to sell out of their warehouse. That's been a big driver for warehousing, but it's seen as a very stable area to invest in. We're still going to be pushing very hard, trying to find good opportunities, and may even be building some of these opportunities out, because as the market picks up and as the shortage occurs, there are going to be opportunities, I think, for development and give out good returns.
I think that's one of the things I didn't mention, which is also a positive for our neighbourhood centres. Coles and Woolworths in many of our centres are now using them as distribution points for their online shopping, and we get a share of the revenue, the turnover from that business, as well as customers coming in store. So the online shopping in one sense has been good for us in terms of the neighbourhood centres. The other thing, just with the industrial, for the industrial assets that we've accumulated over the last few years, the compression in yields, the buy prices now for those assets is very strong. So I think we've done really well with the acquisitions that we've made in the past.
Yeah. The other growth area and the other area that we think is a good opportunity is in the agricultural sector.
Yeah.
The agricultural sector has been able to give us some good returns. And some people have misread it that what we're doing in the agricultural side of things is that what we're doing is we're buying farms where there is a tenant, and we're not taking on the direct agricultural risk. And with these farms, we're looking at them where they need to have water, they need to have dependable income, and so that from our investor point of view, they lower the risk. But the kind of properties we're buying are ones where it's fruit production, it's intensive farming, and we go and analyze the tenant and we say, can the tenant pay the rent? And that's the number one thing that we look at. Is it dependable earnings? Does he have water? Do we eliminate the majority of the agricultural risks? And then we'll look at the covenant and how good the tenant is. And what we've been able to do is to accumulate and to put together into this one trust some really, really good properties. We've got, for example, Lamantina, which produces about 55% of all the celery that gets consumed in Australia. Again, that property has got fantastic, dependable
They're high-tech enterprises, aren't they?
They are high-tech enterprises. They're sophisticated farmers. But that particular farm has got 3 sources of water. It's in a climate that for the last 18 years has produced a regular crop every single year.
Yeah.
And those are the kind of properties we're looking at. And that particular one, even if it's on the Mornington Peninsula, it's got 27 titles. Even if they stopped farming tomorrow, we'd get probably more for the farm as selling the land.
It's interesting. The valuation on that one was purely based on the underlying land value and no recognition of the business. So I think that was a very good acquisition.
Well, the other one that we've got is Panangata. That one's leased out to Kagami. Kagami is a $2 billion Japanese operation. So we don't have the agricultural risk. The tenant pays us regardless. And the beauty with these is that they are normally 10-year leases, triple net, no cost from our point of view. And so you're getting a pure return. Into that trust, we've now acquired Rolf Binder Wines, the vineyard that sits alongside it.
Right in the middle of the Barossa Valley.
It's a very well-known brand. And not only that, it operated, and the tenant is now Accolade Wines, which is a pretty substantial operation. Again, we're not taking on the agricultural risk. We're not taking on, whether there's drought or not. In that particular instance, that property's got water, so you don't. It's pretty much drought proof. We've then also bought Roller Orchards, and that one does plums, but plums that have got high antioxidants. They get a premium in the supermarket. Again, got its own water, well-established brand, developed farm, producing good income and a good tenant. Piscaneri, which is, they produce table grapes, leased out to Montague. Montague are a business that have been going for 80 years, pretty substantial tenant. And we're now looking at, we haven't finalised it yet, but we're pretty comfortable that it is going to happen. The Batlow Apple Orchard. Fabulous asset. What we've seen and the reports that we've got will be absolutely fantastic. Again, it's got its own water. It's leased out to a fantastic tenant. And with all of these together in the current trust, we're able to pay and will be paying our investors a return, a cash-on-cash return of 7.25%. But what I didn't mention, John, we were looking up the statistics the other day. Australian farmland has grown compoundedly by 7% per annum for the last 20 years. Now, I'm not saying that that's going to continue to happen. There's no reason why it shouldn't. But, even if we get 3 or 4% in capital growth.
On top of the income.
On top of the 7.25, you're getting nearly 10, 12% returns. And that's pretty healthy. And not only that, but your risk is now spread over 5 different properties. I wouldn't say totally risk-free, but it's as good as you get, and they're just fabulous properties.
They are. And so you can get the impression that we're quite excited about the agricultural space. One of the reasons is that it's not as competitive as some of the other spaces, as David mentioned. Industrial is very, very hard to buy on decent yields. And we've picked up a very, very good guy who looks after our agricultural assets. He's just done a flyby, a drone little video, which we'll be sending to you for the Batlow acquisition. And it really is a great way to see these properties. And as I mentioned, they're very high tech these days. It's not farming as you might have imagined it 20 or 30 years ago. They're very sophisticated, and they do a lot to reduce the risks involved in the business these days.
Yep. So that's an IM that's open, that if you wanted to discuss with any of us, feel free to give either John or myself a call, or Larry. Most of you would know Larry, or Paul for that matter. But that's an opportunity that is open at the moment. And like I say, I think pretty safe and good returns.
Yeah, it's a nice asset class. So, look, we might leave the presentation there. And so just to wrap up, once again, to confirm that David, Jim and I, all of the team in the Perth office will remain in place, very committed to our business. We're very conscious of the goodwill that comes from our underlying investors, our underlying investors, and we can give you our assurance that nothing will change here, and that the best thing that will happen is that you'll get more opportunities alongside the ones that we currently offer. So from my point of view, thank you very much for your support these last many, many years, and we look forward to a strong future going forward as well.
Yes, again, thank you for your support, and would, like you say, to many more years together.
So we'll keep you updated as we go. Thanks very much.
Thank you.